Quick test. Imagine you open your brokerage app tomorrow morning and one tab is gone. No quotes, no green candles, no red candles, no today's movers, no after-hours drama, just your account name and a blank space where the price used to be. If your first thought is, then I can't do anything, that's the tell. Not because you're stupid, not because you're lazy, because somewhere along the way, modern markets trained you to confuse two very different jobs, watching and investing. Benjamin Graham would have said the market is there to serve you, not to instruct you. But in 2026, the market isn't just there. It's in your pocket, vibrating, begging for attention like a slot machine with a news feed. And here's the part almost nobody wants to admit out loud. Checking prices all day doesn't make you informed. It makes you suggestible. It turns your portfolio into an anxiety dashboard. So let's do something that sounds almost illegal in the finance world. Let's build wealth on purpose without checking prices all day. Not by ignoring the market, not by pretending volatility doesn't exist, but by designing a process that doesn't require dopamine updates to function. There's a single number Graham would care about more than the stock price flashing on your screen. We'll get to it, because once you understand that number, the whole obsession with quotes starts to feel optional. For most people, the real goal isn't beating the S&P 500 this quarter. It's retiring with dignity. It's not being one layoff, one medical bill, one recession headline away from panic selling at the bottom. It's building a portfolio you can hold through noise, through bear markets, through whatever the next once-in-a-lifetime crisis decides to call itself. So I'm going to give you a simple Graham-style system. Think of it as a one-page price-blind plan. It has 4 parts: a base that keeps you from being forced to sell, an autopilot that keeps you buying when your emotions don't want to, guardrails that keep you out of speculation disguised as investing, and a calendar so you know exactly when to look, what to look at, and what to ignore completely. By the end, you'll know how to invest with the temperament of a defensive investor, even if the world keeps trying to turn you into a day trader. Now, before we build the plan, let's name the enemy clearly. The enemy isn't volatility. Volatility is just weather. The enemy is the belief that if you watch the weather constantly, you can control it. You can't, but you can build a house that doesn't collapse in a storm. Graham's great gift was not a magic stock formula. It was a psychological upgrade. He took the investor's biggest weakness, emotion, and replaced it with structure. That's why he invented Mr. Market. Mr. Market is your business partner who shows up every day and offers to buy your share or sell you his share at some price. The price isn't true. It's just his mood. Some days Mr. Market is euphoric. He's talking about the next big thing. AI, quantum, biotech, the new industrial revolution. Whatever story happens to be trending, he pays any price and calls it the future. Other days he's depressed. He's sure everything is falling apart. He discounts great businesses because he's scared. Graham's point is brutally simple. Mr. Market is not your teacher. He is your opportunity and your temptation. If you keep checking the quote, you're basically letting Mr. Market ring your doorbell every 5 minutes. Eventually, you open the door. Eventually, you do something you didn't plan to do. So the first move in building wealth without checking prices all day is not a spreadsheet. It's boundaries. But boundaries only work if you replace the old behavior with a better system. Otherwise, You just sit there feeling deprived, and then you relapse the next time the market dips 2% and your brain screams, check. So, here's the price blind. Plan. Part 1 is what I call sleep well money. Graham would simply call it a margin of safety in your life, not just in your stocks. If you don't have cash reserves, every downturn becomes personal. Not my portfolio's down, more like my life is down. That's when people liquidate retirement accounts at the worst possible time. That's when you see the tragic math of a middle-class investor. Years of disciplined saving erased by one forced decision. Sleep well money is the difference between I'm choosing to hold, I'm trapped. For a lot of Americans, that base looks like an emergency fund in something boring and liquid, cash equivalents, a high-yield savings account, short-term treasuries, T-bills, whatever fits your situation. The point is not yield chasing. The point is stability and access. Because when you have that base, you stop checking prices for the most dangerous reason people check prices: fear that they'll need the money tomorrow. And while we're here, let's say something unfashionable that Graham would nod at. Boring is an edge. Cash and high-quality bonds aren't failed stocks. They are tools. They reduce the odds that you become a forced seller. They reduce the odds that you turn a temporary market decline into a permanent personal loss. That's the first layer of margin of safety, not in a valuation model, but in your household balance sheet. Now, part 2 is Autopilot Wealth. This is where the modern American investor has an advantage that Graham's generation didn't always have: automation. If you have a 401k, a Roth IRA, an IRA, even a simple taxable account with recurring investments, automation is not convenience, it's behavioral armor. Dollar cost averaging isn't a promise of higher returns, it's a defense against self-sabotage. It turns investing into a routine instead of a reaction, because the market's job is to move. Your job is to contribute. Let me say that again, because it's the sentence that replaces checking prices all day. The market's job is to move. Your job is to contribute. And yes, fees matter. Expense ratios matter. A portfolio that looks brilliant on paper can be quietly robbed by friction. High fees, excessive turnover, constant trading, tax drag. Graham was obsessed with the investor's real net outcome, not the fantasy outcome. So when you build Autopilot Wealth, you want it to be low cost, diversified, and boring enough that you don't feel the need to manage it every afternoon. For many defensive investors, that means broad index funds paired with a sensible asset allocation. Stocks for long-term growth, bonds or cash-like instruments for stability, and rebalancing to keep risk from drifting. And if you're more hands-on, if you want to do stock selection the Graham way, automation still matters, because the best analysis in the world won't save you if your behavior is wired for impulse. Autopilot Wealth does two things at once. It keeps you buying through volatility, and it makes price checking irrelevant, because your contribution schedule doesn't care about headlines. Now, here's where people get uncomfortable. They'll say, okay, I'll automate, but what if the market is overvalued? What if we're in a bubble? What if this is 2000 again? What if this is 2008 again? Good. That question is healthy. That question is the beginning of investing, and it leads directly to part 3. Graham guardrails. Guardrails are rules that prevent you from falling off a cliff when emotion takes the wheel. The most important guardrail is the one Graham drew in permanent ink. Investment is most intelligent when it is most businesslike. If you own stocks, you are not owning tickers. You're owning pieces of businesses. So the quote is not the truth. The quote is an offer, and that's where the number comes in. The one number that matters more than the price flashing right now. It's the earnings yield. Most people know P/E, price to earnings. But that's still price first thinking. Graham would flip it. Earnings yield is earnings over price, E over P. It answers a simple question. For every dollar I pay, how much earnings power am I getting? If a stock trades at a P/E of 20, the earnings yield is about 5%. Before growth, before changes, before anything else. That's not a prediction. It's a starting point. Graham used this kind of thinking to compare stocks to bonds, to interest rates, to the opportunity cost of capital. It's a way to stop staring at the price and start evaluating the deal. Because here's the mental shift. Wealth isn't built by watching prices. Wealth is built by buying cash flows at reasonable prices with a margin of safety and holding through mood swings. So your guardrails begin with value, not hype, not vibes. Not everyone on social media is talking about it. Not this AI stock is the next NVIDIA. Not my friend doubled his money on options. Graham had a word for that world. Speculation. Speculation isn't evil. It's just not investing. The danger is when you speculate while calling it investing, because then you use retirement money, you use leverage, you use emotion, and you pretend it's discipline. A story stock is the modern form of speculation in a suit. It sounds intelligent, it has a narrative, it has a huge total addressable market, it has a charismatic CEO, it has a cult following, and sometimes it even becomes a great company. But Graham would ask, at what price? And what protections do you have if you're wrong? That's what margin of safety means. It means you're humble enough to admit you can be wrong. And you're serious enough to build the plan so being wrong doesn't ruin you. Now, margin of safety can exist in a few forms. For the index-focused defensive investor, margin of safety is not "I've found the perfect bargain stock." It's diversification, quality bonds or cash as shock absorbers, a savings rate, and contribution plan that keeps compounding alive, rebalancing rules that force you to buy what's down and trim what's up. For the Graham-style stock picker, margin of safety shows up as financial strength, strong balance sheets, manageable debt, solid liquidity, earnings stability, profits that aren't pure fantasy, reasonable valuation, paying a price that gives you a buffer, and a refusal to buy businesses you don't understand. You don't need to be a CPA to do this, but you do need a checklist. Graham loved checklists because they reduce the room for self-deception. So here's a practical, modern Graham checklist you can actually use without turning your life into a full-time analyst job. First, financial strength. Look at debt, not just some debt. Look at whether the company's debt load is reasonable relative to its earnings and cash flow. In rising interest rate environments, weak balance sheets don't just wobble, they snap. Second, liquidity. Can the business handle a rough year without begging the market for capital at a bad time? This is where current assets, current liabilities, and the general health of working capital matter. You're looking for resilience. Third, earnings power. Not one lucky year, a pattern. Graham cared about the ability of a business to earn money through cycle. In modern terms, you want to be careful with companies whose profits disappear the moment the narrative cools. Fourth, valuation. P/E can be a starting point, not the finish line. You can look at earnings yield, free cash flow yield, and compare them to what you'd accept from safer alternatives, you're not trying to be perfect. You're trying to avoid paying a no mistakes allowed price. Fifth, dividends and shareholder discipline when applicable. Not because dividends are magic, but because they can signal a mature business model and real cash distribution. Again, business-like thinking. And here's the most underrated line item on the checklist: your own temperament. If you can't hold it when it's down 30%, you don't own it. You're renting it. That's not a moral judgment. It's a design constraint. So the guardrail is to only buy what you can hold through volatility without checking the quote every hour. Now, you might be thinking, fine, I can build a base, automate contributions, and follow guardrails. But how do I actually stop checking prices? Because my brain still wants to. That brings us to part 4, the calendar. This is the quiet weapon. The calendar is how you replace obsessive monitoring with deliberate review. Here's what most people do. They check prices daily, sometimes hourly, and then they review their actual plan maybe once a year. If that, that's backwards. Graham's approach is the reverse. You make a plan, you review it at sensible intervals, and you ignore the day-to-day mood swings that are designed to hijack you. So here's a calendar that fits real life, especially for the middle-class investor trying to build retirement wealth while raising kids, paying rent or a mortgage, and living in the real economy. Daily, nothing. No quotes, no just checking, no after hours, no pre-market, no futures are down. Nothing. If that sounds extreme, remember, you're not refusing information. You're refusing noise. Weekly, 10 minutes for personal finance, not the market. Look at your cash flow, your savings rate, your debt payoff plan if you have one, your next contribution. This is the part you can actually control. Monthly, contributions and allocation. Confirm your automatic investing happened. Confirm your asset allocation hasn't drifted wildly. If you're using broad funds, this is usually a quick glance, not a decision-making session. Quarterly, business review. Only if you pick stocks. You can look at earnings reports, changes in fundamentals, major balance sheet shifts, and whether your original thesis still makes sense. Notice what's missing. Did the stock go up? That's not a business review. That's an ego review. Annually, the real meeting. Once a year, you do the deep work. You rebalance. You reassess your risk tolerance. You check whether your portfolio still matches your time horizon, especially if retirement is getting closer. You look at fees. You look at taxes in a general sense. You look at whether your plan still matches your life. And here's the key. You decide in advance what would cause you to take action, not in the moment, not in a panic, not under the spell of Mr. Market. In advance. This is how you stop checking prices, because you stop needing prices to tell you what to do. Now, we have to talk about the moment that breaks most investors, the crash. The crash is where all philosophies get audited, and the reason people check prices all day is because they're trying to feel the crash coming early enough to escape it. But crashes don't feel like scheduled events. They feel like confusion. They feel like headlines that don't line up. They feel like just this once I should do something. So here's the Graham truth that sounds cold until you realize it's liberating. If you need to sell during a crash, the mistake happened before the crash. It happened in the structure. Too much risk for your temperament. No cash reserve, no bond ballast, no margin of safety, no plan for rebalancing, no written rule for what you do when the market is down 25%, 35%, 45%. When you fix structure, the crash becomes survivable, not pleasant, not fun, but survivable. And survivable is the whole point, because compounding only works if you stay in the game. So, write one sentence now. Yes, an actual sentence. That becomes your crash rule. Something like, when stocks are down sharply, I do not sell to feel better. I rebalance according to my plan, and I continue automatic contribution. Or, I only sell if the business is permanently impaired, not because the quote is ugly. Or, for the purely defensive index investor, I rebalance on schedule. I don't rebalance based on fear. That one sentence does more for your long-term returns than 1,000 price checks, because it prevents the catastrophic move, selling low and waiting for the perfect moment to buy back in. That perfect moment rarely arrives. What arrived is regret. Now let's close the circle back to where we started, the missing price tab. If you had the price blind plan in place, that missing tab wouldn't scare you. You would still know what to do this week. Contribute. You would still know what to do this month. Keep your allocation sensible. You would still know what to do this year. Rebalance, review, refine. You would still know how to handle a crash. Follow the sentence you wrote, you were calm. And if you're a Graham-style stock investor, you would still know the only question that matters when Mr. Market is screaming, what am I getting for what I'm paying? That's earnings yield thinking. That's value thinking. That's business-like thinking, not what did it do today? Because today is Mr. Market's mood, not your mandate. So here's the practical challenge. Take a piece of paper or a note you can pin somewhere and write your one-page price blind plan. Keep it simple. Your sleep well money target, your automated contribution schedule, 401k, Roth IRA, whatever applies, your asset allocation, the mix you can actually stick with, your guardrails, low, fees, diversification, no leverage you can't afford, no story stocks without margin of safety, your review calendar, monthly contribution, annual rebalance, quarterly fundamentals only if you pick stocks, and your crash sentence. Then do something that sounds small but changes everything. Remove friction in the right direction. Make buying automatic. Make selling inconvenient. Turn off price alerts. Unfollow the accounts that monetize your panic. If you want market news, choose one weekly recap, not a 24/7 drip feed. You're not avoiding reality. You're choosing when to engage with it on your terms. Because the secret of building wealth without checking prices all day isn't that you become indifferent. It's that you become intentional. You stop outsourcing your emotional state to a blinking number. And that's what Graham was really teaching beneath all the balance sheet ratios and valuation logic. The investor's edge is not prediction. It's discipline. Mr. Market will still knock tomorrow. He'll knock next week. He'll knock during the next recession scare, the next inflation scare, the next interest rate pivot, the next AI hype cycle, the next meme stock frenzy, the next this time is different moment. You don't have to answer every time. You only answer when the offer makes sense for your plan. That's not just how you make, that's how you keep it. This is Benjamin Graham Investing. If you want to go deeper, the next step is learning how the defensive investor builds a retirement blueprint that survives volatility, and how margin of safety applies not just to stocks, but to your entire financial life.